Hello everyone, Assalamu alaikum. This is Ahmed Chawi, or this is Liquidity Club by Ahmed Chawi. Today is the 14th of November 2023. It's Tuesday. You're currently seeing the DXY daily chart. We have CPI in about 2 minutes. Now let's drop down. As you can see on the daily, we have walked inside this daily fair value gap, and we have touched inside this bearish order block. Now what I'm expecting is CPI driving price lower. We have a sell side liquidity right there. So we walked inside. This is a high. This is considered to be a high probability bearish order block because we swept the buy side liquidity. We broke lower. We have a fair value gap and we have a bearish order block. So this would be considered as a high probability bearish order block. We traded to it, accumulated orders, and now we're trading lower. So on the 15 minutes time frame, you can see price returning to the bearish order block right there, trending lower. We have a sell side liquidity right there. This could be uh, we can see price trading and attacking the sell side liquidity. For studying purposes, we're looking at CPI just for studying purposes. We're not trading it, so we're just studying how price reaches from or how price attacks liquidity pools. So we have the buy side liquidity. Don't know if I can cover ES, but let's check it out. Let me positions. Uh, I'm gonna be explaining this entry right there and the TP shortly. Uh, on the daily of ES, you can see that we've attacked the higher time frame objectives, these buy side liquidities, and we still have this fair value gap. We have the rest of this fair value gap, so we can see price attack them. So price attack the sell side liquidity. We can see the buy side liquidity being attacked next. Let's go to the XY. No, beauty. You can see even on the lower time frame, or not on the lower time frame, like CPI is to be considered a day by itself. If you can see the PO3 price opened, traded up higher, took this liquidity pool, and then after it took the liquidity pool, it traded lower. So we're attacking the sell side. As I've mentioned, why am I justifying lower prices? So I literally called out lower prices before the 8:30, and we in fact seen that this is not a hindsight, or this is not being cherry picked. I'm literally just telling you what I've seen and what I want to see price doing based on the things that price has printed earlier on. So you can see that we formed buy side liquidity above these highs. We swept the buy side liquidity, then we traded lower. So we have a bearish order block. This is a high probability bearish order block. Price traded accumulated orders at the bearish order block, filled this fair value gap, and now traded lower. Going to ES, you can see price is trading up higher as I was expecting. Look at that. Now the same thing is mentioned here on the ES. Price has opened, traded lower, took out the sell side liquidity. Look at this. All of this liquidity pools that were there. And by the way, you can see that I've entered. I'm gonna be explaining my entry later on, and you can refer to my Twitter account. I've shared everything about the Twitter, so you could be looking at that also. You can see how price has taken the sell side liquidity, taking the sell side liquidity, took the buy side liquidity and just continued to running up here. So it opened here, traded lower. Everyone who was trading here and considering this as support, relating to retail theories of support and resistance, so they will think that this is the resistance because price has high here and it now touched this high and traded lower. So everyone will trusting that this is going to be going lower. Right there, price when it broke this low, many people have believed that it's going to be trading lower. Then it continued running up higher. So both of the liquidity pools, the people who were short from this high and the people who shorted below this low, right there. Some people have their sell stops. They want to sell on weakness. So when price break below this low, they will be into the marketplace short. So they will be induced at this candle right there at this low. Later price will break up this high. Their stop loss is gonna be above these highs, and we can see price how attacks them and reaches for the other objectives that I've mentioned. Let me uh, show you the positions, execution levels. All right, I'm gonna explain to you everything about this entry. Let's go to the hourly chart. All right, you can see how we have. Let me remove, but I just want to show you the levels. All right, so as you can see, we price has created lows here, swept the lows, traded up higher. This is considered as bullish breaker. This is the ICT bullish breaker. This is the ICT bullish breaker. Price traded to it here, rallied up higher. The people who caught this move, unfortunately, they're gonna trail their stop loss below this low. Price trades lower one more time, attacks these lows, then rally up higher. When it rallied up higher, we have now a low, lower low, higher high. So this would also be considered as I'm not gonna so here's the importance of refining your position on lower time frame. Since price has taken this low, we can drop down to the 15 minutes time frame. You can see right there we have our bullish breaker. So we have the same closing price here, the highest close, but we consider the one with the highest wick since they are both equal in terms of the closing price. So you can see I've entered at the bullish breaker. This was a permanent entry on the lower time frame. These also. I was aiming at this high as low hanging fruit, and we definitely got that. And we got that here during London. So you can see during London, that small tick you can see I've entered there. What is the what is my exit? 4,436 and 3/4. What is the high on this candle? You can look up here. This is the high, which is abbreviated for the high, H for the high. You can see the high is at 4,436 and 3/4, which is I've labeled it right there. This line represent the high of this candle. And we can see price attacks it right there. And then trades lower. It the whole time is doing that is just to generate and engineer more liquidity above and below the marketplace so retail can be part of. Then price has broke lower one more time, took out this low, and then run up higher to my objectives. If we can check the daily time frame, you can see it has reached to this fair value gap that I've mentioned. I literally mentioned that before CPI, and we've seen price attack them perfectly. Hello, Giraffe. Hope you're enjoying the stream. So back to our topic here. So price has attacked then after attacks the sell side liquidity, it attacked the buy side liquidity and reached to my targets. I've set my limit order at the let me show you the daily, at the low of this fair value gap. So I had two partials, the high of this fair value gap and the low of this fair value gap. The high, which is the low of this candle, and the low of this fair value gap, which is the high of this candle. And you can see price. I've taken my profits right there, right there. The 4,446 and three quarters, and the high is at the 4,447 even. So measuring the spreads, which is one tick, I've got out there. And this is not being photoshopped or anything. You can see. And I'm gonna show you here. Right there. So this is not being in photoshopped or in hindsight. And as always, resetting the accounts. So I'm gonna be explaining more about why yesterday was more of a, let's say, a low probability due to illiquid conditions in the marketplace. Firstly, let's start with the higher time frame. As you can see on the higher time frame, we've reached to the buy side liquidity right there. So our higher time frame objectives have been met. So when your higher time frame objectives have been met, it is advised that you work inside the intraday charts, and you refrain from expecting a large range days. And we in fact seen that yesterday on Monday. The price was basically indecisive. No, retail will call this doji, and it's not doji, it's just generating and engineering more liquidity above and below the marketplace. So smart money can be making use out of it. So since our high time frame objectives have been met last week on Friday, there was no reason to trade on Monday. So if you've ever been or if you've ever traded on Monday yesterday, now this is a lesson to you, a lesson for you to be learning from it. Price has attacked the high time frame objectives. After the attacking of the high time frame objectives, it is better for you to walk inside the intraday charts and refrain from trying to catch the large moves, because all the time after large moves you expect consolidation, and this is what we've seen. On Friday we have a large move, and then on Monday, which is the day after it, we've seen a consolidation. Now this is one of the reasons. The other reason is that where Monday was a day after holiday. On the 11th of, I believe, on the 11th or the 12th of November, we have a bank holiday, which is the Veterans Day. So it is always advisable for you that you don't trade the day before the holiday, the day of the holiday, and the day after the holiday. So some holidays do allow trading until noon, and then after noon it's going to be closing. The market is going to be closed. But either way, what is really advised that you don't trade the day before or after the holiday, and of course not the holiday itself, because the large funds or the liquid is not going to be present in the marketplace, which is going to be sure is going to be moving relative to the concepts that are behind these markets, but it's not going to be moving with speed and magnitude that you're looking for. So it's going to be having a lot of give and take, deeper retracements, longer consolidation periods that many people are not going to be um, weathering because it's going to be hard for them to be setting in these period of times. And it is better for you to not trade them because you might think that this is going to be like this forever, and it's not the case. It's always going to be these low probability or high resistance liquidity run in the marketplace are required to trap retail to make use of their liquidity. Anyway, this was the second factor. The third factor is yesterday or Monday we had no news drivers. So because we had no news drivers on Monday in terms of high, medium to high impact news drivers, because we had none, this means that retail are not present in the marketplace. Usually, retail are gonna be utilized, their liquidity is gonna be utilized to make use of it. So we're gonna be waiting until the news hit the marketplace. Many of the retail are gonna be positioned before the marketplace trying to catch the move. And the market many times will just be moving to their stop loss and then showing us the real direction move. And this is in fact what happens all the time. If you go to chart and you could be back testing and studying your charts, you'll see that this is the case that happens all the time. So there was no news drivers, so there was no injection of liquidity at all. The third fact, I think that's the third factor. The fourth factor is that it was a day before CPI. As I've mentioned, today is CPI, and we've just hit the announcement just being made about 14 minutes ago. So before CPI, it is advised for you to be not part of the marketplace because why? You always have the question of why. I'm gonna be answering you. The answer is that before these three, what three news drivers? NFP, non-farm payroll, FOMC or the interest rates announcement, and CPI. These three high impact news drivers are considered to be like a scary drivers for large funds. So many of the large funds are going to be sitting out or sitting on the sidelines on these before these events. So let's say before NFP on Thursday, like Wednesday New York PM session, Thursday, and on Friday in London, this period of time that I've just mentioned is going to be more of a high resistance liquidity run or low probability because large funds are not existing in the marketplace. Their liquidity is not in the marketplace at the moment. So the market is going to be illiquid, as I've mentioned, it's going to be giving a deeper retracements to accumulate liquidity that is going to allow the price to move to its intended direction or intended objectives and deeper consolidation. So there are two types of um, liquidity engineering techniques that can be implemented in the charts, and they are the longer longer consolidation period of times. This is going to be building liquidity above and below the marketplace, and we have the retracements. Retracements always happens for price to be, let's say, buying or selling at, and then price will attack it one more time, so it's generating sell side liquidity, let's say, and it's going to be attacking the sell side liquidity one more time for the people who are trying to catch the bottom, and then it's going to be moving to the higher time frame, let's say buy side liquidity. If it was bullish, it's going to be forming a low, and after forming the low, it will attack that low to trap many of the people who are trying to catch the bottom and to continue going or running up higher. So because of that, it is advised for you to not be trading before these three high impact news drivers that I've just mentioned, which are the NFP, FOMC or interest rate announcements, and CPI, because the liquidity that is going to be sending price with the speed is not going to be there. So you're going to be like weathering a very slow market at, at these period of times. So this is why primarily why it is advised for you to not be trading at these times or at these period of times. Let's check Euro USD. Although we're not trading currencies due to all the geopolitical things that are happening around the world. You can see it is bullish. We form now bullish order block, and basically it is I don't know what are these. Due to all due to all of the geopolitical things that are happening around the world. I've mentioned this in the last two weekly reviews on my YouTube channel. You can see that what is happening now around the world is affecting the XY, and as a result, can affect the major currencies, which are the euro, pound, New Zealand dollars, Canadian dollars, etc. So these currencies can be affected because they are coupled or they are being traded with the USD, which is a DXY, the US dollar index. So because of the things that are happening around the world, especially the BRICS nation, they're trying to come up with their own currency that is backed up by gold. This is going to be affecting DXY, and it can send it to zero because realistically speaking and technically speaking, DXY or the US dollar is not backed with anything. And this is mentioned in the currency itself. If you go and take a note, a dollar note is going to be mentioning it literally in the note. It's going to be mentioning in God we trust. So it is illusion. Like there's nothing backing up the XY or the US dollar. They're just putting their hopes in God. So they're just mentioning you can like right now you could just take a note of any note and you just see the sentence mentioned in God we trust on any dollar note. So it's really absurd and it may really affect DXY in the long term. So this is why it is preferable for you to not be trading the forex market, although we can see that it is moving quite good. Like it's respecting the you can see bullish order block, price trading to the bullish order block. We had a bullish breaker, but price didn't reach the bullish breaker. So there is a sell side liquidity. We can later take out the sell side liquidity, reach the bullish breaker, and we can continue running over here. This could be one of the possibilities that can happen. So as you can see, we have here a fair value gap. Need to keep price can reach to it. Pound USD, we still have the buy side liquidity. You can see that pound is a bit weaker now to the upside. If you would look at no, Euro USD, it has attacked this buy side liquidity. But Pound USD, on the other hand, it didn't take this buy side liquidity. It didn't take this buy side liquidity right there. So this means that if we close from here and in the future we might be forming an SMT and this price can trade lower. And one of the things that I've mentioned, we can take out this lows because price always move from internal range liquidity to external range liquidity and from external range liquidity to internal range liquidity. This is basically the phenomena of price action or the marketplace. It's always moving from discount to premium and from premium to discount. I'm not considering the wicks because the wicks are where the retail are gonna be attacked. We're looking at the bodies. You could be considering the bodies up here. You can see price traded lower, barely touched discount, traded higher. Now, if we continue running right there. We have the discount here, and just below discount, what do we have? Bullish order block. Price can retrace, accumulate more orders at the bullish order block, and then continue running up higher. Or if we close below the bullish order block, if we close below this level, this is telling us that we might take out this low, accumulate more orders at this bullish breaker, and then continue running up higher. Or it may just reverse and start trading lower. Let's check on thank you. Price is close from reaching to this buy side liquidity. We have the filling of this fair value gap. Now this is a refined fair value gap. This is a refined fair value gap. So the fair value gap is from this high. Originally the fair value gap is from this high, from this candle's high to this candle's low. But because price has traded up higher until this point and then started trading lower, now we have a refined fair value gap. So it's gonna be mentioned as refined fair value gap. So we can see price, if it attacks this high, what other objectives or what other higher prices can we look for? You have this fair value gap. You look for the high, low, constant encroachment, and you look at the quadrants. So I could do it here just to show you the price levels, but I'm gonna be removing it to keep my charts clean. We have the high, my bad, and basically my charts. Here are the levels. So we have the high of the fair value gap comes at 15,929 even. We have the consequent encroachment comes at 15,892 and a quarter. We have the low of the fair value gap, which comes at the 15,855 and 2 quarters. And basically the quadrants, the 75% and the 25%. These are the levels that price can be reaching to them. So you should take note of all these levels, because price, if it attacks this high, and this is what I'm expecting, this is what we're expecting from price to attack this high. If it attacks this high, how further can it reach to the upside? As I've mentioned, we have the fair value gap, the low of the refined fair value gap, which is basically the buy side liquidity, the consequent encroachment, the high, and the two quadrants, which are the 25% and the 75%. So these are primarily the levels that I'm looking at if price attacks this buy side liquidity. Look at this. How many points? Price opened here, opened at, excuse me. So price here opened at about, I'm looking at this info right there, opened at the 15,900, 15,592 and 2 quarters, and the high is at the 15,812. That is roughly 200 points. 200 points in just one. Let's go to the 1 minute. I'm gonna show you. That is roughly about more than 150 points in two minutes. About 200 points in less than 2 minutes. Like your stop loss, if you were looking for lower prices, let's say, and you didn't see lower prices, price immediately just traded lower, so you were happy about that. And then price traded higher. If your stop loss was above this high, I'm gonna tell you, you're not getting out at this high. many times your buy stop is gonna be, or your sell stop or your stop loss is not gonna be respected because of the spreads, because of the how the market is gonna be moving at this specific minute. So you're gonna be incurring a bigger loss that you want in the first place. Let's check on ES. How many points on this? We opened at roughly 4,430, and the high is at the 4,467. Yeah, that's still like 50 points. You know what's 50 points? That's the average daily move. So the average move for ES is about 50 handles in a day. And for the forex market, it's usually 100 pips. So 100 pips for forex, it's usually equivalent to 50 handles on ES. And we've seen that happens in 5 minutes. Now, for the people who's gonna be mentioning that, oh, you were trading this. No, I didn't. I wasn't trading this. You can see my positions I've entered before that here. Oh, I reset my account. Anyway, you could be, you could just rewind the video. It's already mentioned there how I've showed you, and I've showed you why did I take that trade. It's not based on, oh, because this low has been broken, I'm gonna be trading here, and my stop loss is below this low. No, it's not that. My moves are very being calculated into the marketplace. I'm not being pressing the buttons prematurely, just for your info. So now what I'm expecting, since we've we've had this gap here, or we have this fair value gap. So this area is has been delivering to the upside, or to buy. This is buy side delivery. So we want to see sell side delivery to fill out this area. So we can see price retrace, work inside this fair value gap or this area to make it efficient. We have a bearish order block. You can use the bearish order block as targeting purposes, and you can use it as means of entries. The BD arrays are used for both the entries purposes and the targeting purposes. Price attacks the sell side liquidity. That is wonderful. Look at this. I've literally mentioned this before the CPI numbers came out. Literally before the CPI numbers came out, and I've mentioned that we were likely to take out the sell side liquidity and reach to the sell side liquidity. And with what we've seen, exactly as I've mentioned. And this is not hindsight. You can rewind the stream and you can see how I've mentioned them. It's not I'm not making these things up. All right? Price is approaching the fair value gap on euro. It's also approaching the buy side liquidity here on pound. Now, if it takes out this high, I'm really gonna be listen to what I'm saying closely. If price takes out this high, I'm mostly I'm not gonna be expecting price to take out the low that was created on euro. So this low right there. If price on pound, if it takes out this high, I'm not gonna be considering euro to be taking out that low that I've just mentioned. But if it keeps this high intact, so if it didn't reach to it, it's about 15 pips away. So if it didn't reach to this high and kept it intact and we closed, I'll be considering that we formed a high, short-term high on euro, and we might see price retrace, takes out the low that I've just mentioned, and then continuing running up higher if it wants to, because usually in December we get a rally, Santa Claus rally. You can see since I put the mid price is also approaching the buy side liquidity here on NQ. So I've shared my what I'm expecting for NQ. This is what I'm expecting. These are the levels that I'm looking at here, like this week for ES. It's roughly gonna be the bearish order block here. We have this Fibonacci gap. This can be used now as an inversion Fibonacci gap, so price can retrace and use the high or the consequent encroachment of these levels as support that can send price higher to the bearish order block. So this could be, and we have a small fair value gap right there. I'm not gonna be plotting it on the charts to keep the charts clean, but price can attack the bearish order block as means of targeting purposes, and we have a small fair value gap here. Now on the daily time frame, if price closes above the consequent encroachment, so basically if price closes above the 4,528 and 2/4, if price closes on daily time frame above this level, I'll be considering price to take out this high and this high. So we have relative equal highs here. These highs, there are there are liquidity resting above these highs. So we can see price takes out these highs if we close about that level that I just mentioned. Otherwise, it can just accumulate orders at the bearish order block, trade lower toward discount, and it can attack the discount and keep trading lower. Regarding the XY, we've already seen our objectives met. This low, we have this low if it really wants to reach to it, and this low. Now below these lows, we have a fair value gap here, which is a refined fair value gap. We have also here the sell side liquidity. So we have the sell side liquidity here, and below the sell side liquidity, we have the fair value gap. So price can attack the sell side liquidity and reach to this fair value gap. So how further below the sell side liquidity price can reach to this fair value gap? The low, the high of this candle, the low of this candle, the consequent encroachment, and the two quadrants. Basically, the low of this candle is the sell side liquidity. We have the sell side liquidity here. The consequent encroachment, the high of this candle, which is the low of the fair value gap, and the two quadrants. If we trade below and we're trading to it, so we tapped into it roughly, or we're close from reaching to it. Yeah, we're very close from reaching to it. Yeah, we're actually close. So if it continue running up higher and if it was animated to the downside, we can see price attack this fair gap right there. So we've just mentioned NQ, ES, DXY, Euro. As I mentioned, the fair value gap now it's trading inside of it. We have these three consecutive up close candles, which are the bearish or the block. If price also close above the mean threshold of this bearish or the block, which comes at this level, 1.08640. If we close on daily time frame above this level, I'll be considering price to attack this buy side liquidity. So let's mark it as buy side liquidity. Otherwise, price can just walk inside this fair value gap and continue or trade higher and take out this low. This is regarding euro. Let's go to pound USD. As I mentioned, on pound we have this buy side liquidity, and above this buy side liquidity, I believe we have this buy side liquidity, but we have here an implied fair value gap. Now, what is implied fair value gap? It is the consequent approximate of these two levels. This is going to be a rough level. It's not going to be the absolute. You can go to your charts and you can calculate the absolute level. You could see that the low of the implied fair value gap is the high of or the buy side liquidity. So it's going to be influential. So this is going to be the implied fair value gap. Price can trade above this high, and how further above this high can it reach to? We have this implied fair value gap. Now, if we close above this implied fair value gap on daily time frame, we can treat the high and the consequent measurement of the implied fair value gap as resistance or as support, excuse me. That can send price higher towards this buy side liquidity right there. So this is going to be roughly what I'm looking or what I'm expecting from the marketplace in the near short term future. I think that's going to be pretty much it for CPI tape rating. It was a phenomenal study of liquidity. The market is going to be opening in about 20 minutes. We don't have any other news in the market other than FOMC members speaking, which are Barr and Goldsby. But it's not going to be injecting a lot of liquidity as the high impact or mid impact news drivers. The news drivers that I've just mentioned are low impact news drivers, so they're not really impacting the marketplace or injecting any of the liquidity. So that's going to be pretty much it for this tape reading session. I wish it was insightful to you as much as it was insightful to me. It was really beneficial for me as I was studying price action and I was studying liquidity, how price has been running from premium to discount, then from discount to premium one more, from premium to discount one more time. So it's basically running from earning external liquidity, trading lower, running external range liquidity here, trading up higher, filling the internal range liquidity, then attacking the external range liquidity one more time. Now we can see it close here, attack the internal range liquidity one more time, then trade lower, attack the external range liquidity and the fair value gap, and that's how the market moves. So it was a phenomenal study or the case study for me. I hope it was insightful to you as much as it was insightful to me. That's gonna be a wrap up for today's session. I'm gonna be live streaming and we're gonna be case studying NFP, FOMC interest rate announcements, and CPI every month. So you could be expecting me every month on NFP, which is roughly the first Friday of every month, and FOMC, interest rate announcements, and CPI, because these news drivers are really beneficial for you to study them to understand liquidity and how the market makers really drive the market from buy side to sell side and from sell side to buy side from um it's basically like including many of the ideas, looking at inefficiencies, big arrays, etc. So I hope you found it insightful. Until I talk to you next time, be safe. Assalamu alaikum wa rahmatullahi ta'ala wa barakatuh. Peace.